term interest rates. We will look at the short term interest rates and what kind of impact they have with the term structure of the interest rates, and how does the volatility of the interest rates impact the term structure. And we will introduce to a concept of, or probably will relook at the concept of convexity, based on how is the convexity impacted, one with the maturity period. We'll try to see what are the factors that will impact the convexity of a bond, primarily looking at the maturity as well as the volatility of the security or volatility of the underlying interest rates, and based on that, see if at all I have to look at incorporating a risk premium into the term structure and do the pricing of the bond. How will I go forward doing that? So these are some of the key things that we would cover as a part of this session. So to start with, the term structure. What is this term structure? What are going to be the interest rates over the next few years? A kind of depicting of the interest rates for the future is what we are calling as the term structure of the interest rates. What are going to be the spot rates? Probably what is the 1 year spot rate, 2 year spot rate, 3 year spot rate, or probably long term rates. Now what we are saying is these rates are purely based on the expectations of the future short term rates. Right, this was actually propounded as a part of our expectations theory also here, but when we use the word here, we are using it in a slightly different context, the expectation of the future interest rates. So the word itself is saying expectation of the future short term rate. There are two ways of putting it. Okay, right now if the interest rates are 7%, if I am saying the next year also the 1 year interest rate is going to be 7%, means 1 year spot rate next year is going to be 7%, or this is an expected rate. I am expecting that the 1 year spot rate next year is going to be 7%, or the other way of saying it is, yeah, the expected rate is 7%, but the possibilities are there could be 8% or 6% with equal probability. Still the expected is 7, right? But there is a difference between saying the interest rate next year can be 8% or 6% versus saying the interest rate next year is